Ladies and gentlemen, good day and welcome to the Pennar Industries Limited Q4 FY23 earnings conference call hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectation of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Vilas Suryavanshi from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Ryan. Good morning and very warm welcome to everyone. Thank you for being on a call of Pennar Industries Limited. We are happy to have with us management of Pennar Industries for question and answer session with investment community. The management is represented by Mr. Aditya Rao, Vice Chairman and Managing Director, Mr. Srikanth Bakkar, Vice President Finance and Chief Financial Officer, Mr. Manoj, Head Corporate Affairs, and Mr. K.M. Sunil, Vice President Investor Relations. Before we start with the question and answer session, we have opening comments from the management. Now I hand over call to Mr. Aditya for opening comments. Over to you, sir.
Thank you, Vikram. I hope I'm audible. Please let me know if I'm not.
Yeah, you are audible, sir. Yeah.
Thanks. My thank you to the moderators and our stakeholders for joining the call today on Pennar Industries Q4 and FY23 financial results. The structure we will follow will first cover our profitability, our liquidity and our growth. Post that, our CFO, Mr. Srikanth Bakkar, will present his analysis of our results. We will take questions from all of you after that. So for the overview, we've recorded net sales of INR 668.4 crores for the fourth quarter. Our PBT for the fourth quarter was INR 30.63 crores. For the financial year, we recorded net sales of INR 2,894 crores and our PBT was INR 98.44. Now, this represents growth of about 27.7% in net sales and about 76% PBT. Our cash profit, which we generated for the year prior to payment of taxes, was 140 crores, and the PBDT was 160.4 crores, which represents growth of 48.5%. We had committed that our PBT would be the highest ever after accounting for extraordinary items in previous years, and I'm glad to note that we have achieved that with a PBT of 98.4 crores for the year. And if you look at our cash profit as well, that is also the highest cash profit ever recorded at 140 crores. The PBT we generated, 30.63 for the quarter, was at a margin of 4.58%. As committed, we expect further improvements in our PBT margin as we continue to move from lower margin revenue profile to higher margin revenue, and this also has a effect of increasing our capital efficiency. Our cash PAT for Q4 was INR 41.1 crores, which we generated at a margin of 6.15%. Moving to liquidity and capital efficiency, our working capital days as on March 31st was at around 75. Our ROS for the year was 19.8%, and the annualized ROS was substantially higher, which was good. Now, we had indicated that we had wanted to see a ROS of about 20% being achieved by March 2023, and again, we're glad to have achieved it, just like we've hit our profit targets. Our target for the next financial year is to achieve a ROS of 22%, and working capital, our target is 72 days. Moving to growth drivers, what's going to drive our revenue and our profitability growth in the future. For the next quarter and for the financial year, our PEB division, our US subsidiary PGI, our body and white division and our engineering services business all have well-baked business plans, which are I am quite with a high degree of confidence we are sure that they will continue to drive revenue and profitability growth for us for the next few quarters, for the next financial year. We are continuing to work on growth projects for our hydraulics, our large diameter tube and our module business. And we are hopeful that once these business unit capexes, these assets get commissioned, they will also continue to be significant drivers of our revenue growth once completed. So that completes my summary of our performance for the quarter and the financial year. covering profitability, liquidity, and growth. I will now hand over the call to Srikanth for his comments.
Thanks, Venkat. Welcome to the show, shareholders on the fourth quarter and the year-ended financial 23 earnings call. The key metrics for the year, predominantly revenue has increased from 2,265 to 2,894 crores, which is a growth of 28%. Broadly, if you see the revenue, this is coming in consolidation as well as in standalone. The increase in revenue in standalone is 294 crores, and in subsidiaries it is 335 crores, which grows up to 694 crores. The increase in the U.S. business is presently from the metal buildings division what we have, and in India it is coming from the BIL, PV vertical and ECD division what we had in the last year. EBITDA has increased from 188.42 to 254.62 crores, which is 35%, and in terms of percentage, it has increased from 8.31 to 8.8%, which is 50 basis points higher than last year. PBT is at 98.43 crores. We are also happy to inform that the shareholders we have reached the highest ever profit after removing the exceptional items which was there in 2017-18. Just to take you through the movement of the balance sheet and cash flows. Movement in terms of PPE is the major when compared to last year to current year. This is on account of the BIW capitalizations which we had last year, 55 crores, and in India and in the US around close to 15 crores. Even with the increased sales, we are able to reduce our debtors, which is reduced from 425 crores to 381 crores. That was a decrease of 44 crores. And in terms of number of days, this has helped us get our working capital days as well, which is close to 20 days. You see the increase in inventory. Increase in inventory predominantly is for the quarter, subsequent quarters that we have taken. In terms of liabilities, the reduction is in the equity share capital is due to the buyback that we had in the last year. Overall, in terms of long-term borrowings, there is no movement, and it is from 98.59 crores to 98.82 crores. The increase in the short-term borrowings that you see from 489 to 522 days, it is because of the increase in the working capital. Overall, working capital number of days, as we discussed, they are well within control, and 75 days when you take the gross working capital. As we discussed, we are in the process of shutting down our lower margin businesses, part of it, and which is helping us improve our top line, and which is basically improving bottom line. With the better working capital measures, we are also able to reduce our finance costs. Our finance cost as a percentage of our total cost has come down below 3%, but as we see the revenue increasing, the finance cost will be as a percentage of the gross revenue. It will be continue to be 3%, and net revenue around 3.3%. The other income includes foreign exchange fluctuation, duty drawback, income from mutual funds, and certain write back of the old debtors and provisions which we have collected. Our ROC has improved from 14.7% to 19.98% for the full financial year, and our ROE has improved from 5.69% to 9.68%. We are sitting at the highest ever cash balance of 172 crores, and if we add up the investments that we have in the mutual funds, it is close to 199 crores. So with this, I close my comments and hand it over to the moderators for the Q&A session.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from Mayur Lehman with Profit Mart Securities. Please go ahead.
Thank you for the opportunity and congratulations on good set of numbers, sir. Sir, I just...
Mayurji, can I request you to speak up a little bit, sir? Your voice is not audible.
Okay, sir, no problem. Now it is good?
Yeah, it's better. Go ahead, sir, please.
Okay. I just want to guidance on what are the key steps we are taking toward the railway and tube to scale up the revenue.
Okay. The two of the revenue streams you mentioned were railways and tubes. Railways in the current quarter is doing well, and we expect the next quarter also it will do well. But however, as I've been mentioning in the previous conference calls, our growth drivers right now are the IW division, EB, engineering services, PGIS, and subsidiaries. All of them are poised for driving our bottom line growth and our capital efficiency strongly. Railways, most of it coming from, well, the railway board. I don't have a lot of transparency into how sustainable these revenue streams are. So in the short term, it's doing well. It will do better than what it did in the last few quarters in Q1 and Q2. But I don't have sunlight for you in terms of an abject addressable market value proposition for railways, which will scale over the next few years. So as of right now, we are not deploying any additional capex into railways. Our existing assets capacity utilization increase will result in revenue growth. That's for railways. For tubes, it's the other end. I think the large diameter tube project is something we find very compelling. We think our markets in India, both in India and as an export market to the US, are very, very strong. And we've had an uptick in our tube supplies to the US as well. So I'm quite confident that once we complete the implementation of that project, we will be able to see a dramatic increase in our tubes revenue and our tubes output. So that is projected to be completed in this financial year.
Okay, sir. And second question on the Accent business. What kind of movement do you see in the Accent building business, and which things give you the confidence about the future performance about the Accent building?
So Accent is a metal buildings business in the US, and it has, as I'm sure you're aware, done very well last year, and we expect it to do better than that this year as well. A capacity increase over there is being commissioned. We are adding a beam line. We're also adding other supportive capital assets. Our order book there is quite strong. It's been growing for the last 3 or 4 months. I know there's been talk of a US recession, of a decrease in potentially in addressable markets, but from what I see, and as I mentioned last time, maybe in the tech sector, we are not in that sector, so I can't really comment intelligently about that. But where we are present, which is the non-residential construction sector in the US, I think it's as strong as it is. So we expect a very strong Q1 and a very strong financial year. So just increase of order book combined with an increase in our capacity in the US will make sure Accent will continue to do well. So did that answer your question? Or?
Yes, sir. And the last question, how do you see the FY24 in terms of the order book size and the domestic and the international business size, specifically Europe side?
Yeah. So I will break that up into domestic versus international, which is not actually the standalone versus consolidated. It doesn't actually break up that way because there's a lot of exports. But from a market point of view, our order books at EB are at a record high. Our order books in Accent are also at a high, as I mentioned. Our orders in solar are quite strong. Railway is also going up, but there's caveats to what we're projecting as far as railways is concerned. So we don't see addressable market decline, which is what results in order book decline, which is what results in revenue, say, or profitability not being able to scale. So in our growth drivers, we don't see a decrease there. Both the domestic and international revenue streams we have will continue to do well, and we are projecting that there is good, strong, consistent addressable market and order books that are there for us for both the domestic and international business. From an attribution business, I think whatever the percentage we've been seeing, the significant majority of it will be domestic and some of it will be international, say about around 30%. So that trend will continue. We don't expect higher growth in international or exports versus domestic. Both are growing. Both are performing as per our expectations.
Okay. Thank you so much, sir. That's all from my side.
Thank you, Mahesh.
Thank you. Our next question comes from Venkat Subramaniam Raman with Organic Capital. Please go ahead.
Hi, Aditya and team. Thanks for taking the question, and congratulations on running a very tight ship among, under challenging circumstances. A couple of questions from my side. In the year that's gone by, what are the areas that have kind of made you happy, and what are the areas where you could have potentially improved? Two, there is a fair amount of excitement in the railways addressable area in the domestic market. Having gone through what you have, are quite circumspect there. So you wanted to concentrate in the railway asset on some of the export opportunities or some more value-added opportunities, etc. Where are we with respect to that? And thirdly, we had a small tuck-in in Europe which was one of our customers who we thought could open up some doors on the aviation side. So if you can just give some update on that. Thanks.
Thank you. Thank you, sir. So the happy and sad areas of the last year, what was happy was that we achieved the financial metrics. I wouldn't say sad, but I take it more as a challenge. Some of the areas I think that we should work on is further improvements in capital efficiency. I think aspirationally, 20% ROAS is not appropriate. Aspirationally, our cash profit base of 6% cash PAT margins are not appropriate. I think we have to head to a place where we are better in terms of margins, add more value to our products, have good, long, sustainable markets. So that exercise is ongoing and it's a challenge. I think with BIW coming on, with our US business going, with engineering services increasing, with hydraulics increasing, with large diameter 2 coming on, all of these are high margin businesses. All of these are capital efficient businesses. So I think our medium-term growth is to hit 30% ROAS. We're right now quite confident 22, 23, 24, but over the next 2-3 years, steady, measured improvements in these two metrics. So we push our PBT margin up and we push our ROAS margin up is our goal, and that's the challenge ahead of us. And we're quite, as a team, I can commit to you that we are very enthusiastic about having to work on those areas. I think we are thinking that we will see it will be hard work, but we are committed to achieving it. Railways, as you mentioned, yes, I've talked with some of our competitors. I've talked with people who are in other businesses, related businesses for the railways, and yes, I definitely see that there's some amount of energy there. But at least the model that we follow, sir, is good, strong, addressable markets, good, strong assets. If you have both of those, you will always have revenue and you will always have profitability. Whenever we see companies not doing well or failing on revenue or profitability, it's either because their addressable markets are not strong or their assets are not strong. There's no other reason really for those. Maybe some governance other issues, but that's not relevant right now. So in that vein, single customer, railway board controlling the gross capital formation, orders being given, state-owned entities competing with them, the approval basis, RDSO, that's I don't believe that is a playground for us. I don't think that's where we want to build our base. But as you said, we are exploring our export markets, and the railway business is doing well in the sense that if you were to compare Q1 to Q1, if you were to compare Q2 to Q4, growth is there, and it remains a good margin business. I'm just saying that for us, it's not just what happens in this quarter or next quarter. I would like us to think of what happens over years, right? What is Pennar going to look like 5 years from now? That's a more important question. On your last question on Cadnam, sir, I'm happy to report it has turned profitable. Early days still, but I am quite confident. We have a new CEO for that business as well, Mr. Patil, who's joined us, and from a large multinational firm. And I think we are committed to growing that business. and it's profitable now, and by the end of the year, I think it will start contributing to our revenue profitability as well. But these are small businesses and addressable markets right now. Over time, they will become more mature. For this financial year, our growth drivers will continue to be, as I mentioned, PGI, PEV, BIW, engineering services, and by the end of the year, hydraulics, large diameter will also start pushing. So we have multiple growth verticals, 4 or 5, which are looking very promising. All the order books look good and strong. India looks strong. US looks strong for us in the markets we present in. So I think we'll do the work to make railways and aerospace BU into something that follows the same paradigm.
Wonderful, wonderful. Happy to hear. Couple of more. One, if CFO can report on an ongoing basis, the write-offs that we did as of about 3-4 years ago, and what the recoveries on that have been, and on a regular basis, report on ECL provisions and then recovery thereof on a consistent basis, I think it will be useful.
Shikhar, do you want to answer when you can give that?
Yeah. We've actually report those numbers as part of other income. Does that cover up? But we'll give you a broad numbers there. I think 13 crores is what the number that we have, which is collected, whatever we have provisioned earlier years, and ECL provisions continues to be higher. So you will have this because of the standard where it is. You will have the higher provisions which will come in the current year as well. But by next year, this will moderate off, and you will not see the further increase in those provisions again.
Understood. And lastly, Aditya, on the engineering services side, which is the software support that we provide out of Hyderabad and Vijayawada, how are the numbers scaling up there? What kind of additions have we seen? That looks like a fairly large opportunity. What kind of focus do we have there, and what are the challenges there?
Good question, sir. I think, as you mentioned, it is a key focus area for us. The markets we are typically chasing in that includes building information modeling, structural engineering, automotive BIW design, and also plant engineering. So those are the 4 verticals where we provide engineering services, design services, product development services. It's doing very well from a percentage growth point of view, but both, all of these together represent from a revenue point of view only about 70-80 crores. So it's small, even though the margin is substantial. Our goal is that since a lot of these markets are quite big, right? That's why I say addressable markets are to be big. If your addressable market, if your quote activity is high, then your order book will be high, then your revenue will be high. So on that basis, we are right now expanding our business development team both in Europe and also in India. US right now we are not, but that will also come into play over the course of this year. But there's a lot of work in progress happening in this business. But one thing I can tell you right now, we're very bullish about it. It's going to continue to see very good growth. I'm proud of the job that Suman and his team have done on this business, and I'm sure this will also become it's a high margin business. It's about 20%. I'm certain this will start becoming a key profit vertical for us very soon as well. But yes, that's the status right now, sir.
Wonderful, wonderful. Thanks a lot on all the best.
Thank you so much, Ramanji.
Thank you. Our next question comes from Gaurav Agarwal with 91 Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, if I see the difference between your Concall and standalone on a quarterly basis, so last quarter the revenue was from the subsidiaries. It was around 156 crore, which has reduced to around 113 crore now. So one thing is how much of this difference between Concall and standalone is related to the engineering business sitting in the Ascent USA.
So most of the change that you see is because of Ascent. So let me describe the why of this in a little more detail. So in India, we follow the financial year, which is Q1 starts in April and Q4 obviously ends in March, as you're aware, I'm sure. So in the US, all of our subsidiaries follow, and frankly, business there usually. January to December is the model that is followed. More importantly, Q4 tends to be the strongest quarter for us in India, usually, not in India for most Indian companies. Whereas in the US, Q4, or what we call Q4, is It's a time to take stock, make budget plan. There's also a lot of inclement weather, at least in the market that we are present in. So effectively, Q1 tends to be the weakest thing. So it's a within a year cyclical variation that you see. Most of our subsidiary income, as I said, comes from PGI, and you will see this number performing better this year, substantially better this year than last year. And at this point, I'm on the basis of our order book being where it's at, which is higher by almost 30% from just 2 months ago, our US order book. I'm not projecting a decline in this year's ascent revenue, but you will see these quarter variations because the strongest quarter for India is actually the weakest quarter for US businesses. So that's the reason you see the revenue attribution going around. Going forward, I think we've done the math and we think 70-75% will be India, 25-30% will be outside India. That's what we are typically seeing from a revenue point of view.
Okay. And sir, just to get a bit more clarity, so last year, in FY23, full year subsidiary numbers are 600 crore revenue. When you say they will do much better, so can it be a 1,000 crore business in FY24?
I will not be giving guidance, but I can assure you we will see double-digit growth in both our standalone and our consolidated businesses. So which kind of answers your question, but yes. Okay. And sir, coming to your margins, again on the subsidiary side, there is a lot of variability in margins. If I see the EBITDA margins of the subsidiary number, it was let's say 4.8% in Q2, then it was 10.7% in Q3, now it is 12.7%. So now the revenues have declined, but the margins are improving. So sometimes it doesn't add up. Even the employee expenses, they vary so much. The other expenses vary so much. So what exactly is the nature of business in those subsidiaries? So our US subsidiaries, our international revenue has always been high margin. I am not aware of any revenue stream we have which is outside India which is low margin. That's point one. So any variations you see are just quarter-on-quarter scale impacts, which is, as I said, the Q4 to Q1 variations. That does exist. From a point of view of what do our margins, revenue-wise, what's happening and our margins are going up, that is a stated intent for us. We have, as you may be aware, exited our water EPC business. We have exited our retail business. We've exited our MMS business. These are all large contributors. Hundreds of crores, right? And the reason I've done this is because as we finish our order book in these businesses and get out of them, there is a minus from a revenue point of view, but they aren't businesses which for whatever reason, we've not been able to generate sustainable margins or good growth margins in that. We've chosen where we want to grow our businesses, and those are doing well. So since these are higher margin, you will see impacts where our margins consistently tend to improve. That's something that's a statement of intent for us, and if you not just one quarter, if you see the last, I would say the 7-8 quarters, you would see that trend, and that trend will continue. As of right now, for the next financial year also, we are focusing on margin improvement. Revenue also will increase. I think we have several growth vectors in play, as I mentioned. So our PEB business alone is projecting from last year to this year, we are looking at, even from a run rate right now point of view, it will be at least a 25-30% growth. So I'm optimistic that you will continue to see revenue and profit growth on a yearly basis. Quarter on quarter, US versus India, that I don't see that as something that's a concern.
Thank you. Our next question comes from Ankur Kumar with Alpha Capital. Please go ahead.
Hello, sir. Thank you for taking my question. Congrats for a good set of numbers. So my question is on this, our plan to increase margins and reduce low margin products. So what kind of profit growth can we expect for the coming year?
We will not be giving guidance, but I can comfortably commit double-digit growth for Q1 and for the next financial year.
And would that mean, as in our revenue will continue to go down because in this Q4 it has gone down because we are looking at high margin products?
No, our revenue will go up as well. We will have, for Q1, we will see double-digit growth in revenue compared to last year, and we will also see growth in profitability. For the reasons that I explained previously, that's the Q4 impact. But And also the revenues that we are dropping away, as we said, we're removing the low margin business. There's an end to that, right? I mean, we've almost exited MMS business. It's almost done. So the future impacts of these are quite limited. So I don't believe that you have to worry about our revenue going down further. Its revenue growth is important. It's a stated objective for us that we increase our addressable market, thus increasing our asset base, thus increasing our revenue, and that's how you increase it. You can't keep increasing margins also forever, and margin increases are extremely difficult. But I can commit that whatever revenue we add will be good quality, sustainable, and good margin revenue. So we can commit to revenue growth next quarter, if that's your question.
Got it, sir. And sir, on balance sheet side, our debt is increasing, and also we have not been paying dividends for last couple of years. So any thought on those two things?
Overall debt is flat to my knowledge.
Overall, I'll just take you through borrowing number. In terms of borrowing, 98.59 crores to 98.82 crores. That's the long-term borrowing. That's flat. In terms of borrowings, that has increased 489 crores to 522 crores. So when you look at this number, you have to look at, because all the current liabilities numbers are predominantly working capital numbers, and working capital will grow up as the revenue grows up. So what you will have to see here is finance cost as a percentage of our total revenue, which we intend to cover between 3 to 3.3%. That's a broad range that we want to give, because in certain months it does change. So the overall borrowing numbers are flattish. We have not increased our borrowing substantially.
And to your other questions on we generate a lot of cash also, Shrikar. I think it's 199 crores, almost, let's say, close to 200 crores in cash also has been generated. So debt equity also is looking better. Dividends, corporate actions, the board will take a call, sir. We are reviewing, and if you have anything, we will share. It would not be appropriate for me to say anything on that. No, but we have done buybacks. I would say we have completed a series of buybacks, and the last buyback we completed was about 1 year ago. This year, last year itself, and we did that at an average price of about 45. They're substantially higher than that. So I believe we've had some success in our corporate actions as well. But yes, anything on dividends or anything, as the board has decided, I will share with you.
Got it, sir. And sir, one last thing on this ROCE calculation, we are saying that we are at 20%. So it would be great if you can put that calculation in the PPT going forward.
Okay. That's somehow it's there. We will include that. It is EBIT divided by the working capital that has been employed. I'll share you the calculations as well.
We'll get the calculation to EBIT divided by capital employed. We'll get that.
Sure. Thank you, sir.
Thank you.
Thank you. Our next question comes from Deep Gandhi with Astute Investment Management. Please go ahead.
Yeah. Hi, sir. Good morning.
Hi, how are you?
Yeah, sir, I'm good. So, sir, most of my questions are around this PV division. So initially, I just wanted to check with you that in the quarter, so if I see your quarter-on-quarter revenue in this division, so it's actually degrown, and we've also seen some reduction in margins. So if you can highlight what was the reason for this?
Oh, yeah. So as I mentioned, that would be our U.S. business versus the overall. But what I can tell you is our PV business is actually, and we see it as a star performer in this quarter. I mean, revenues in India are at the highest level ever. Margins have also increased substantially. As I mentioned, Q1 is a time to take stock in the U.S. We also have PEB in the U.S. Even there, the order books are at a high. So I would say you look at it in terms of the year in question, sir. But from a quarter point of view, Q1 for the U.S. is always going to be weak for us. In India, it's the other side of the picture as well. Q1 is actually looking, Q4 has been quite strong, and Q1 is even stronger.
So, sir, can you break up this number in terms of what was the Indian revenue specifically for PV and the margin, so we can get a sense what has been the growth?
Sure. Our revenue for the last quarter, for India versus US? Yeah. Do you have those numbers?
Oh, okay. PET versus on an average last year we did the US $7.25 million US. Current yearly, which has fallen to 6.5. So that's the decrease that you see in the US business versus the India business. have the overall year number where we have increased from 554 crores to 725, which includes the other stuff also, which is, if you take only PV business, it is 396 versus 590 in the India.
So this number you have given for Q4 FY23 versus Q4 of FY22, right?
Financial year, the 590 crores was for the full financial year, PV business in India.
Okay, sure. And what kind of margins you do in the Indian business?
We generate, the operating contribution margins are about 14%, and we expect to improve those substantially. So another way to look at it, any growth that comes in at a double-digit margin from a profit drop point of view. So
this 14% is only for the PB division, right? The margin.
That's correct. Yeah, that's correct.
Okay, sure. So my next question is, so you have shared this number that you have a 750 crores of order book for PEV. So if you can highlight the number of customers from whom you've got this 750 crores orders.
So it's pretty diverse. As of right now, Reliance is big, about 200 crores is just from Reliance, but it's actually 750 crores as of March 31st. I apologize if I misspoke. On a right now basis, it's closer to 830 crores. So it's a lot of customers. It's not one or two or three or even four. I think you would see
More than 40.
Yeah, more than 40. And as of right now, we're active at 30 projects across India. And in the US also, it's around 10 sites right now. So, yeah.
So if you can just share the number, how much of this 830 crores is from, say, top 5 customers?
I'll try to get you that information. A lot of times our customers don't want, they're okay with us telling the market that we've received orders from them, but the exact order value is something we sometimes are informed. And I do need the clearance to give you customer-wise breakup, but my request you give us some time to check and get back to you on this. However, the overall numbers, which is 830 crore order book, and many customers is what you can take right now.
Okay. Sir, my next question is, if you can also highlight what kind of capacities you have for PEV currently, and what was your utilization in the current financial year?
So capacity right now is about, if you include everything like India and the US, we're at about a 7 B-band capacity, which means we can put out close to about 8,000 to 9,000 tons a month. If you want to look at it per ton, it's not fully appropriate to take only the tonnage number because it's a system, right? It's not just product. It's just not the weight of the product, and there's different kinds of products that go into it. It's a system. It's engineered. It's structural engineering. But from a capacity utilization point of view, I think that was your question, capacity utilization. We are at around 65-70%, and we're trying to bump that up now. We're adding capacity as quickly as we can, also frankly in PV, because the transference from order book to revenue can be a lot better than it is right now. That's one of the reasons why we're very confident of projecting growth, both in revenue and profitability for PEB and other businesses. It's just the rate at which we are booking orders, and our current order book is quite strong. And what we're seeing in the market is that this will persist through this financial year. So we're quite confident.
Thank you. Our next question comes from Darshil Pandya with Fincrist Capital. Please go ahead.
Hello, sir. Good afternoon. Majority of the questions answered. Just one question. What's the total order book across segments as of 31st March? Please provide.
I don't believe we have that number, so I will have to add PEB plus railways plus solar plus other. I would have to add that up, but rather than allow me to get back to you that number. But it's a large number. It would be.
Yeah, as of last quarter, it was 2,500 crore as said by you.
Yeah, it would be in that framework. And do bear in mind that only 50% of our revenue is order book based. The other is what we call scheduled revenue. So it's an indicator for where our revenue is going, but it's not absolute. You will get a half of the picture of where our revenue is going.
Yeah, absolutely. And sir, one last question. That was on the last call you said that maybe 5% of that you aspire in a year or year and a half. So what's the guidance now?
So you would have seen consistent progress on that. I mean, in the last quarter, our PBT margin was 4.58%. So we expect to grow that over the course of this year as well. So one of the things that I think we're making on these calls, we typically make commitments. One of the things we are going to hard commit to is that we will continue to work on margin improvement. It's a stated goal, and we are hard at work at making that happen. So yeah, aspirationally 5%, which we will, as I said, 1.5 years was what we had said in the last call. We are well on track to achieve that.
All right. All right, sir. Thank you so much. Much appreciated.
Thank you. Thanks so much.
Thank you. Our next question comes from Ankur Agarwal with RC Wealth Solutions Private Limited. Please go ahead.
हेलो
Go ahead.
सर ये कंसोल बेसिस पे आपके रेवेन्यू थोड़े से डाउन हुए हैं, लेकिन एम्प्लॉय कॉस्ट 59 करोड़ से 81 करोड़ हो गया है. इसका रीजन कुछ?
हाँ सर. So employee costs are getting higher. Do you want to take that? Yeah. Okay. Go ahead.
Yeah. See, as they say, the way that we've told, the revenue is decreased because of the cyclical business in the US in the Q1. The PEP business has come down, but in terms of employee benefits, they are more or less flat in terms of last year to current year. If you see March 22 versus March 23 is what you're seeing quarter-on-quarter number, but this has already increased the revenue in the last quarter. So it is already increased to 70 crores, and from there it has increased to 81 crores. So employee benefits, we are deploying new machinery, new manpower for our expansion, and that's the reason we have hired certain people, and that's the cost that has been included here.
ये रेगुलर ऐसे इंक्रीज होता रहेगा या यहाँ पे स्टैंड रहेगा सेल्स के रेट?
And we have given out one-time bonuses for the profit share in the US, and that has been achieved in the Q4. So that
increase नहीं होगा sir. I mean, it's not going to keep increasing. It will be flattish from now.
एंड अदर एक्सपेंसेस आपके काफी रिड्यूस हुए हैं, तो ये कोई कॉस्ट कटिंग है इसकी या कोई वन टाइम गेन है इसके अंदर या किस?
See, other expenses broadly consist of job work charges, freight costs, and the stores-based consumption that we had. So there is a decrease of the provisions that we have made from last year to current year by around 10 crores, and there is also job work and erection expenses which is reduced from last year to current year. And as we have stated, our objective is to increase the margin expansion, so we are carefully looking at each cost and spending that amount.
Okay, that's all from my side. Thank you.
Thank you. Our next question comes from Vignesh Iyer with Sequent Investments. Please go ahead.
Congratulations, sir, on good set of numbers. My question is on the two orders that we received, one, if I'm not wrong, on 17th Feb for 850 crores and 8th May for 680 crores. And both the orders, the notice stated that it has to be executed within 6 months. So just to understand the nature of these orders, so it is more on this margin accretive orders like PEBs and BIWs, or it has some orders related to railways and all?
So I can't go into specific orders because we do give out press notes describing our overall order book, but typically the orders book we declare is a blend. So it consists of high margin, or what we would call higher margin businesses, where we get an operating margin of almost 28%, but it also includes some of the lower margin business. It's a blend. So I wouldn't be able to commit on the entire amount that you mentioned, but what I can tell you is that the trend is that we are only accepting orders and across all which have a certain certain margin profile, which allows us to scale, allows us to meet our overall PBT requirements. And if it doesn't fit that, as it has not in some of our revenue streams, we have over the last year, it's over now, we're not exiting any other business, but we have exited business in the past, which don't fit that profile. So specific to the order book we declared, I will not be able to comment on the margin profile because it will be a blend, but it would be what the overall margins you see for the company, what they are at, it will be at the same profile.
Right, but just to understand it, the blend has improved, right? I mean, we are going more margin accretive businesses than we used to, right?
That's correct.
Okay, thank you. And what another thing is we have made a PBT margin of 4.58% for quarter 4. Just to understand it, we'll maintain. I mean, this is more like a base, right? Moving ahead, quarter to quarter.
So your question was Q4 4.58%. That is accurate. What was your question on our?
Yes, I want to understand going ahead for each quarter, it will be more or less like a base, right?
That is our goal. Yes, I can say that. But and yeah, for Q1, what I tend to provide is not quite guidance, but what I do tell you is if we ever see a decline in our profit margins, I will absolutely guide you. But as of right now, our Q1 looks stronger than our Q4. So that should answer the question. So yes.
Yeah. Okay. So okay, sir. That's all on my side.
Yeah. Thank you.
Thank you. Our next question comes from Gaurav Sachdeva with Further Investments. Please go ahead.
Good afternoon, sir. My question is just regarding the EBITDA margins, which is 10% in this Q4. Just I want to ask, can we maintain this EBITDA margins for the whole financial year 24?
Our EBITDA margin is not something we target. We target net PBT margins. EBITDA obviously differs from that in terms of added depreciation and interest cost as well. So we don't have an EBITDA target in mind. So we will not be in a position to commit that we'll maintain 12%. But I don't see a reason why we would decline. I mean, our depreciation is on the higher side and our interest costs are stable and tend to be around the same range, around the Ashika sessions about 3-4%. So if our PBT margins are going up, then obviously that can't happen with our EBITDA margins going down, right? So it's a calculation. So yeah, I can say that we are not looking towards substantial EBITDA margin declines, but what we're committing to you is the net profit margin.
Okay. And so in how many years do you see we can achieve a milestone of 4,000 crore revenue for the company? We'll not be able to give revenue guidance, but the projects we have put in place already gives us an ability to reach that. So we just have to execute right now. So revenue comes from having large addressable markets and having assets, as I mentioned, right? So our markets are all quite big, and our capacity is increased to a point right now also where that isn't unachievable. So, but that is the goal. So more than that also, it's not just 4. We are not going to sit still at 4,000 crores, but yeah, over the course of the next 1.5 years, I'm sure you will see us achieve that from a run rate point of view. 330 crores, I think, is the math. 330 crores per month gives us 4,000 crores. We are hard at work to achieve that, and in the medium term itself, you will see us achieve that on a monthly basis.
Thank you. Our next question comes from Deep Gandhi with Astute Investment Management. Please go ahead.
Yes, thank you for the opportunity again. So just continuing with my previous question. So you had highlighted PV capacity, the total capacity which is, so I missed that number. If you can highlight that again.
Could you say that again? So you said PV capacity.
Yes, the total capacity which you have in PV division currently. I had missed that number.
Yeah, so 8 beam lines, and as I said, you can apply a multiplier per beam line of about 1,000 to 1,200 tons, but it depends a lot on the kinds of projects you're undertaking, how much roll forming tonnage there is, secondary framing tonnage there is, primary framing tonnage there is. So it's not a easy calculation, but it's not a standard calculation, but I think I mentioned 8 to 9,000 tons as a capacity, and you can that's where we're at right now. That's a per month number, sir.
Thank you. Our next question comes from Hari Kumar, an investor. Please go ahead.
Yeah. Good morning, sir. Am I audible, sir?
Yes, please go ahead.
Okay. My question is regarding this with the focus on specific segments like RV content will be market leaders or compete more effectively with the entrenched players, both nationally and internationally, sir?
Yes, sir. In the fields,
also, we focus on this global markets apart from PEB.
So we intend to be a market leader in all of the addressable markets represented. So yes, that applies to PEB. We're right now number 2 or number 3 in India. It's between us and Interact. Kirby is number 1. Our goal is to be a market leader. Doesn't necessarily mean number 1 in terms of revenue. We want to be a cost market leader. We want to be a profit market leader. So that is absolutely on our target profile, and we intend to achieve that. And that's our goal. We do need to be relevant, and if your market share is 5%, 4%, then you can't be relevant. So both internationally and in India. I was talking to our CEO in our US business yesterday, who's here, and he has also told me very similarly that we have to target market leadership in the US as well. So, and the US market is much, much bigger than the Indian market. It's about 5 times the size of the Indian market from a PEB point of view. The same applies for hydraulics. The same applies for our body and white division, which is why I'm saying these are such large addressable markets that we have plenty of headroom to grow. I mean, our competitors are all not a great thing to, in a way it's bad, but it's also good in a way, but all of our competitors are bigger than us in these fields. I mean, Kirby is 2.5 times our size. In hydraulics, Wipro, they're many times our size. BIW is a multi-thousand crore companies exist in India in that field. So our markets are not going to prevent us to grow. We just have to make sure we set our assets up, build good operating teams, get good orders, execute well, and we will scale revenue tremendously. So that's our base plan over the next few years.
That is your international focus also?
Yes. What I'm saying applies to domestic, international. For the purpose of standalone consolidation, yes, but everything's wholly owned. So really for us, we see it as markets, whether it's being serviced to exports out of India or we're manufacturing in the US. It's a market. It's very centralized from a point of view of seeing how growth comes. So
thank you.
Yeah.
Thank you. Our next question comes from Dilip Kumar Sahu, an investor. Please go ahead.
Yeah, am I audible?
Yeah, Dilip, go ahead.
Yeah. So, Mr. Aditya, this is regarding the renewable order from a power PSU. Last call, you said that there's some glitches, it will take some time. So, are those things ironed out, and is it executable this financial year, this large power sector PSU renewable order that we got some time back?
Yes, sir. That is accurate. We had a large order that came in. The execution of that order has started, so revenue on that has started. I don't believe it will complete in this financial year. That's my current understanding. So I do not believe that order will be a powerful driver of our revenue or our profitability in this fiscal. But revenue started. It's very capital efficient, I could say, because of the way the working capital versus the profit is set up. So I'm quite confident that the revenues will start coming in, but we don't currently plan for it to be a big driver of our revenue in this financial year. But revenue started. That's the difference from last quarter to this quarter.
Sure. And it's a very unique, different kind of project from what we have been doing traditionally. So, is the execution going smoothly, or is it like, what is the learning there?
Yeah, it's a good question. My request allows me to say that it's part of our margin profile, and it's part of our. It's not very different from what we've done historically. But yes, we are moving towards businesses which are manufacturing, engineering businesses, which are higher margin, which are scalable, which don't depend on government or PSU. Thanks to them. I mean, I'm sure there are many companies bigger than us who do. Many who are very good at those things, and more respect to them. But for us, private fixed capital formation, diverse number of customers in the automotive sector, customers in the infrastructure space, customers in the engineering space, that's what we focus on, and that market is big enough. If we just execute in those markets, it's enough. So we don't need these PSU orders. So going forward, no, we don't intend to grow that order book.
Sure. So a lot has been spoken about employee expense and all that. My simple query is, In 22, we are 9.1% employee cost to operating revenue. 23, it is 10.7%. Q4, 12%. My question would be, what would be a base compared to operating revenue? Is it 10% is a good base, or is it going to be higher?
It would be lower than 10%. This quarter is an aberration because of what Srikanth had also mentioned. SN did very well, so there's a profit share which was recorded entirely in the fourth quarter. That's the reason for it. You will see it dip below 10%. I do want to mention we don't have an abject control because our businesses are different, right? So our engineering services business, our employee cost is 35%. So it's very difficult for us to say that this we will keep it at 9%, keep it at 10%, because different businesses respond differently. Which is why what is important for us is that we monitor ultimately what are we getting from a capital efficiency point of view and from a PBT point of view. So we have PBT targets, we have contribution targets, we have ROS targets, we have CROS, contribution ROS targets. So those if we hit, we will be in good shape, and we will cover our base goals, which is we measure our performance on profitability, liquidity, and growth. All three will come in. If we set 10%, then if we get, let's say we get a really good engineering order, which is a 20% margin, for the employee cost for that get executed will rise to 25%. Should we do it? Not overall, but for that order, right? So we should still do it, right? So that's the metric we would use. So monitor us on PBT, monitor us on capital efficiency, monitor us on growth rates. This absolutely should be monitored, but do give us some leeway to take the right decision, right calls on this as the revenue growth profile, as revenue profile of the company also goes towards the higher margin businesses, which does mean higher employee cost also, both in the US and in India.
Thank you. Ladies and gentlemen, we have reached to the end of the question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you. I'm grateful for your support. We would not be able to do this, but for you, your candor and your guidance, I'm thankful for this. We are committing that we'll continue the path we're on and continue to scale revenue, profitability, and capital efficiency. Thank you, everyone, for your presence today and for your questions.
Thank you. On behalf of PhillipCapital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.